Hey, everybody that's joining on in. Welcome, welcome. A lot of folks filtering in. Wow, this is actually a good turnout. So far, so good. We normally have like about 30 to 50 folks that hop on in, Joseph and Carla. I know bookkeeping
Awesome.
to some could be a more dry topic. It could be a more fun topic. I will tell you, it is a very necessary part of entrepreneurship and business ownership. And just from like having data to report to understanding your numbers to having an outside opinion, if you will, somebody that might not even be as emotionally vested, maybe like business coach vested, but not emotionally vested, and just unbiased. Um, I've said it many, many times on my podcast. Like one of the biggest things that changed Liz and I's finances, and I got to figure out a better way to quantify it, but it was really honestly just hiring bookkeepers. It was literally like letting other folks in to the machine, you know what I mean? And um, admittedly, back then, finances weren't as good as I would have wanted them to be, if that makes sense. And so, getting naked with a stranger, quote unquote, you're like, I don't know, you tell me, how am I doing? So, but welcome
It
out,
is.
welcome out, everybody. It's awesome to see everybody. If you guys don't know Carla and Joseph, I'm gonna just honestly quickly kick it over to them. They've been on tour. They're on the circuit. They're kicking butt. They're at all the trade shows that you guys go to. They've been at our conference for 4 years now, I would say. I think 4 or 5 years. And I
So
love Carla and Joseph. Yeah, I mean they're good people. I really enjoy getting to hang out with them. I wish I get to hang out with them more, to be honest with you. We're gonna change that in 2025 as we partner up even more. So all things being said, for all of you guys that are hopping on in here, no hard pitch tonight. I asked Carla and Joseph, as you guys know, they're part of Link, if they could just share a little bit more about their services, but really just bookkeeping in general and their reporting feature. Joseph did a phenomenal job at the Boston Mastermind with Mark Bradley about 3 or 4 weeks ago, or it's probably only 2 weeks ago. You know what I'm saying, Joseph? But time flies. So he did a great job, had a great presentation. Some of you guys might have heard that or saw that. So without further ado, Carla, Joseph, I know you got some great things to share, and I'm just going to tee it up and give it to you guys tonight. So thanks for joining with us.
thank you, Brian. Thank you for having us. Super excited to go over some stuff as well. Yeah, and this is a great community, guys. I think sometimes owning a business it could feel like you're on an island. So stuff like this I think is phenomenal for that aspect of being able to share ideas and um, as Brian mentioned, accounting is not necessarily the most exciting aspect, but I think even today, part of the beauty of this is that we are live. So definitely, if you have questions throughout the talk today, definitely, feel free to chime in, or even if you want to just make note and then we can touch it, but either works for
Yeah,
Carla as
yeah.
well.
Take it like as a learning opportunity. We're all in this together. Like if you have a question, that means everybody else probably has a similar question or anything like that. Please don't let us just talk the entire time of these presentation. Ask a question because um, I think that it's an important time of the year to make sure you start off the year right with your financials, and that's going to align with your goal too. Yeah, so just kicking it off. So we're going to start off very basic as far as like the accounting setup and kind of what you're looking at your financials. And then later on in this presentation, we're going to get a little bit more granular. But a lot of the green industry uses QuickBooks Online. And so the advantage of that is that it is an accounting system that's cloud-based, right? You have your phone, you're able to download reports, take pictures of your receipts, and stuff like that. And um, it is a reliable form of having your accounting set up because believe it or not, the QuickBooks Online uses the same servers that back up the US government. So, you know, you can rely on that and have a level of comfort within that. But it also eliminates a lot of data entry work because QuickBooks is always updating with the newest technology, even with AI right now. It's just automating a lot of things, data entry work. So that way things could get done quicker and more accurate at the same time. And so, we see like 99% of the green industry using the online version.
And even with a lot of softwares out there, or even just on the operation side, how they integrate or just um, work within QuickBooks. So that's another advantage as well.
Yes. So when you're setting up your accounting system, whether it be in QuickBooks, Zero, whatever you're using, you're going to set up a green industry chart of accounts. So a specific chart of accounts tailored to the green industry. And the reason why you want to do that is because when you look at your financials, your profit and loss, or your balance sheet, and you want to compare that against peers, like you're all here in this group, right? Maybe you guys want to get together and build some benchmarks for the group in link, or you just want to talk about what your gross profit is just to compare apples to apples. You want to set up the green industry chart of accounts because that will allow everybody to talk in the same language. So all the transactions that happen in your business every day. For example, I go to the gas station and I load up my truck. That's fuel expense, right? That transaction needs to go into a bucket, and that bucket may be fuel expense. So that's what we're talking about, chart of accounts. All the business transactions that occur go into these chart of accounts here. Here's a sample of the green industry chart of accounts that you can use. But not only that, like when you're doing your estimating as well, right? Maybe you have like job or element or something like that that you're doing your estimating off of. You want to be able to take that estimate and kind of um, like when you're done with the job, compare that with your financials. And you're not going to be able to do that if you don't have the green industry chart of accounts like laid out in this way. So that's another reason why you want to have that standardized. And then, once you have your chart of accounts laid out, those buckets that all your transactions are going to go into, then you can do your bookkeeping, right? So your bank accounts you can set them up and sync them within QuickBooks Online. And what it does, it downloads all those transactions. So like I said, when I go to the gas station and I have fuel expense, those transactions automatically pop up every day, right? So then I get to categorize all of those on a daily basis or at least on a monthly basis. And then as well as you want to set up assets, loans, and depreciation. So if you purchase a skid steer mower and you put like $10,000 down today, like all of those big transactions also get categorized in this way too. Another thing is using the service line and location tracking in QuickBooks. In QuickBooks, it's called class tracking. Like if you have an irrigation division, maintenance division, hardscape division, all those transactions can be further classified into specific divisions that you want to put that towards. So if I go to Home Depot and I buy materials, but it's for my irrigation division, I can tell QuickBooks to put those expenses toward my irrigation profit and loss. Or if you have different locations as well, it works the same way too.
Yeah, and that service line or class tracking, that's best used and kind of introduced once you kind of have even maybe separate employees working within each division, and also being able to have, see some of those costs kind of broken out. Once you start to get a little bit larger, because if you're offering multiple kinds of services and you don't have designated people in each division, then it becomes a little bit more of a guesstimating game, and your data might not be as accurate. But once you get larger, once you start to really get those divisions set up, then it could definitely make sense to get some clarity.
Okay. Once you're done recording all those transactions that we spoke about, at the end of the month, you get your bank statement, right? In the bank statement says the beginning balance and your ending balance. So you're going to use that bank statement and you're going to go through this reconciliation screen on QuickBooks. And basically what that means is you're making sure that your bank statement mirrors what's in QuickBooks and you're reconciling it to match the ending balance. That's going to make sure that you're not overstating expenses or that QuickBooks didn't miss a deposit that you made, for revenue for one of your clients or anything like that. And so having that peace of mind that all the expenses and revenues got tracked during that month. Now, there's other reconciliation too that needs to be done for loans. So you may have like a Sheffield loan, and that also also send you a loan statement with your beginning and ending balance. And pretty much as you're paying down the principal on that loan, you're also paying interest. Part of your payment is principal, part of that is interest, right? Now, this is what I see often is that people are not reconciling their loans. And so the interest portion gets missed on your profit and loss statement. So, and your interest that you're paying to these companies, it adds up to thousands of dollars. It's not just a few hundred, right? And so you're missing out on deductions, and therefore your tax liability is increasing. But not only that, if you're using your profit and loss to estimate, your overhead recovery is now off because you're not recovering for those interest costs as well. So that's why it's important to reconcile your loans. Again, you get your loan statement and you go through a reconciliation screen on QuickBooks Online to do that.
I'm noticing either we don't have like marketing and advertising broken down into 5 separate subcategories like postcards, digital, vehicle wraps, yard signs, or whatever, right? Like 5 or 6 different things, or professional services, subscriptions. It just says subscriptions, $3,800. Well, like LMN's $500 a month, and QuickBooks is $100 a month, and Cycles, 200-300 bucks a month. So it's like I just took a screenshot of that earlier. I think you guys said you might share that later. I'm personally interested in that because then I can look at those SKUs and codes and that can cross-reference for my budget. Um,
Yeah.
and I know a lot of folks are making that jump right now into LMN. So this is where you would get from your QuickBooks, take those chart of accounts, is that right? And then
Yeah.
categorize that correctly with your budget. And logging every little jot and tittle thing. It's crazy. Like from interest to credit card fees to subscriptions
Yeah.
to, um, my Adobe suite for $100 a month or whatever on a Mac. Your Dropbox extra 2 terabytes of data for $9.99 a month. Like the best way that Mark Bradley described this at all the masterminds is if you have unexpected or untracked overhead, the only place it can come out of is profit. And
Mm.
so we set a budget for 20% profit for the year, and then you forget to, track your credit card fees or your interest payments or whatever. And you look at the end of the year and you go, well, it was only 11% profitable. What happened? Well, we likely missed all this in the budget. And that's why QuickBooks and a bookkeeper are so foundational. I'm really doing my best to articulate this the best I can to so many folks in the industry. But um, I guess quick question that I was having is, and I get this a lot. I had somebody actually on a coaching call this morning ask, when does somebody sign up for a bookkeeper or a QuickBooks Online? Like what is it, a revenue level? Is it a team size, a company size? I know maybe a very basic question, but for anybody
Yeah.
who, hasn't been even down this far of the road, where do they start?
In regard to that, I would say if it's a part-time thing, um, you're not going to get as much of a value from an advisory perspective because there's only so much of an ROI you can get, right? Because maybe the revenue was not there yet. But once you start to go full time, um, or even if you're kind of projecting to go full time for that given year, that's when it can make more sense. Getting that QuickBooks subscription, and we can even be, I can definitely work with you to come up with a cost effective approach with that as well. Because ultimately it's good to have some of that data and financials for estimating and also for the tax side as well. So I think and I hope that kind of clears that up for you. And like I said, we can whether it's having a little bit less frequent meetings or something like that, we can definitely make it so that you're at least getting that data in order to utilize.
Someone asked, will this help with tax too? Yeah, well, because if you record your interest and if you're reconciling your checking accounts and credit cards, then you know that you're not missing any expense or revenue. You know that this is true to what your business is doing. So reconciliation gives you that peace of mind to know that you're capturing everything.
Yeah, which is that difference if you're looking at things within an Excel sheet or you're kind of tracking it in a different way. Looking within QuickBooks and doing that double check, that helps to really kind of make sure that as Brian mentioned, that you're overhead is not cutting into your profits. So.
Yeah, and then you may be thinking about payroll for this year, right? A big question that I get is like W-2 employee versus subcontractors. Like, what do I do in the beginning? Do I set them up as subcontractors or employees? And under the IRS guidelines, if it's categorized as an employee if they're working under your schedule with your equipment, machinery, and under like they have little control over the project that they're working on. Okay. But if they're not on your schedule, they're working with their own staff, they kind of have free range to do whatever they want with the project, then that's a subcontractor. And it doesn't matter if maybe they're in a probationary period or whatever it is, you still have to categorize them as W-2 employees. We work with Gusto. We love working with them because they're a cost-effective solution, but not only that, like they'll sit with you during your first payroll run and help you get all like the payroll taxes set up and your bank account. And it's broken down very easy. And it only takes like 10 to 15 minutes to run payroll every 2 weeks or every week, however you're going to go about it. It's better. It's a better solution than QuickBooks Online for payroll. And then with that, don't forget that you need to get workers' compensation insurance. And I've seen it where some of the business owners we work with didn't end up getting workers' comp, and then they got audited and now they have this huge bill. So that's been something that pops up often, and you don't want that like financial burden come out of nowhere. So make sure that you're signing up with workers' comp through insurance and before you set up the payroll. Getting into some of the cash flow aspects of the business is accounts receivable and accounts payable. Accounts receivable is the balance of the money due to your company from your clients, like what they owe you, right? And there are best practices when it comes to managing AR that you haven't probably thought about, or maybe you don't have in place yet, but making sure that you pull an AR report each week. So what are the balances owed each week? And that you have a process for it. So is it that you pull it once a week and then every 2 days you send a reminder? Do you pick up the phone and call them on the 3rd day? Do you send a letter on the 5th day? When do you cut off services, right? Is it 30 days in? Is it 60 days in? There has to be a process for that, right? So I think it matters because people not paying you affects your cash flow. So if you have a good AR process and somebody that's held accountable to this, whether that's yourself right now or you have an office administrator, and the follow-up is key, guys, like text, email, phone call follow-up and a sequence of that, and then otherwise just stopping services at a point, right? That makes a huge difference. And then accounts payable. So accounts payable is when you owe other vendors. So an example of that would be if you have a trade credit set up at site 1, right? You go, you buy materials for a hardscaping job or whatever, and it's not due right away. That's what AP means. It's on credit. They extended credit to you. It may be due 15 days from now, 30 days from now. This is a great way to manage cash flow because if I can get the materials in today and I don't have to pay for it until 15, 30 days from now, then I'm going to be sitting in a good position because the goal would be that for that job, I get paid today, a down payment, right? And I go and buy those materials today, but then I don't have to pay those materials until 30 days from now, but I got paid today. So you always have to keep that mentality that you want to get paid first, and then you want to pay your materials after. If you keep that mentality in everything that you do, then you're going to be in a better cash flow position. And when you negotiate your terms with your vendors and you're a good client of theirs, and you kind of schmooze a little bit at the end of the year. You say, I spent, we had a client that we did this for them. We pinned it out their vendor statement, and with one of their vendors, we spent like $300,000 here. Right now our terms is that we have to pay you in 15 days. Can we extend that? And they agreed. They said, they'd rather not us like have to take our business somewhere else. And we're gonna grow this year. They agreed that they're going to extend the terms to 20 or 30 days. So that is going to help out a lot. I think looking at it from that perspective, and even if you work with a few vendors, maybe 2 or 3, that's better, because then you establish a better relationship with them as well. And then making sure that you're keeping up with your tax obligations, your year-end taxes. I know that tax season is coming up right now, with the S corp and sole proprietorship, sole proprietor, your 1040 that goes within that, and then the corporation, partnership returns, but also your sales tax. If you're in a state that requires you to pay sales tax, that could be due monthly, quarterly, biannual, annual. I know somebody was like, now has like a payment plan with the state because they were never charging this, so you don't want to find yourself in that situation. So making sure you're charging sales tax on the right thing.
Looking at more of some of the decisions that you're looking to make in the company, whether you're looking to scale on the administrative side, or just even applies to, adding employees to help out with the projects as well. And I think when it comes to this, always trying to think, I know whether it's LMN or whether it's other softwares or other technology and different things you can leverage, trying to always look at stuff like that, or changing up a process, or improving certain systems within the company before you even maybe try to hire another employee or someone to kind of help out with it, just because that's often going to be a more cost effective solution. And don't judge it as much on how busy you are. Judge it more based on what your company can afford at the moment. So here's an example. $300,000 company A, they're at 10%, which is a pretty good place to be when it comes to your administrative and overhead salaries. So that's anyone who's not actually physically working on the direct project work in the field. So they have a bucket of 30,000, whereas company B, 10% of 1.2 million, they have a bucket of 120,000, right? So let it be more of your revenue and what you can afford, based on that. And as you scale, then that part-time person then actually will turn into a full-time person, or just the different resources that you kind of put together. So we also recommend, especially this time of year, it's something that you feel more when it comes to your cash flow, right? But during the busier times, and when the cash is coming in, still think twice before you ever put on a fixed cost, right? Because you're having to incur that year round, right? So are there things that you can utilize during those peak times that are more of a variable expense, or something that you can kind of dial back if you have to, right? During the winter time, right? So instead of purchasing equipment and having those payments year round, can you rent it? Is there certain spend in regard to marketing or other resources needed that you could be a little bit more flexible on? Can you have some of your team work remote, or is there a more cost-effective space for for your facility, right? So thinking about all these things and being proactive, not when you have to and not when you need to make these cuts, but more of just kind of building into more of that mindset. And from an accounting side, there's a lot of different numbers to be looking at, right? And it could get overwhelming. And that's really your metrics, right? But then you can kind of dial it down into what's called KPIs, or key performance indicators, in things that you can, as a business owner, look at and say, okay, yeah, we have all these different metrics, but I'm going to be meeting with my accountant or I'm going to be looking at my numbers. These are things that I should actually focus on. This is what actually is going to drive the performance of the company. This is how I'm going to be able to make a nice profit, right? And achieve my goals for the year. So here's an example of some of the different metrics and KPIs and things, right? And I think as a business owner, finding ways to dial that down and organize it in a way that you can then actually use to make decisions, right? So, okay, what then happens if we kind of organize this where okay, some actually are more related to profitability, some are more related to efficiencies in regard to the labor or liquidity. So liquidity being how well you're able to cover some of your debts and liabilities and expenses, asset usage, right? How well you are utilizing some of your equipment and trucks, leverage, right? So almost similar to how a bank were to look at your company and based on risk, right? So now all of a sudden you're able to um, look at it in a way where you can kind of see the financial health, almost as if you were to go to a doctor, right, and look at your own health.
Well, whenever too, like you're making business decisions every day, right? And some of those are big, are large decisions where it has a financial impact. Everything has a financial impact. And we want you to look at your financial statements to make those decisions. So if I said, oh, like my truck keeps breaking down, I need a new truck, or I'm going to get a new crew, I need a new truck, then which one of these would I look at to help me make those decisions? Like which of these KPIs? First I'd look at asset usage, right? How well am I utilizing the trucks that I have in place right now? What's my utilization with those? Is it, am I doing well currently or am I not doing well? And then I may look at my liquidity. Do I have money for a down payment or not? Right. So using these different items to help you make those decisions, whether you're looking to add on another crew or team member, maybe you're going to look at efficiency and profitability right now to kind of see if you have room in your budget to kind of add on this next employee now with the projections that you're making with revenue, things like that, So making sure that you know how to use these KPIs. So we'll get into that a little bit deeper here.
And then even approaching it within some of our reporting and you can get benchmarks in various sources. I know the National Association for Landscape Professionals has some of that posted. Um, we use internal benchmarks for the companies that we work with. Um, so within our reporting, you can see, and really, like as an example, wanting to be in that fourth or fifth percentile, right? So this is where you can kind of see that quick glimpse, especially as a business owner. You're not really, maybe you don't necessarily care what the equation is for fixed asset turnover or some of these things, right? But you know, looking at it more like this and having that glimpse, and I think it's important to have a basic understanding of each division of your company, whether it's recruiting, sales, marketing, accounting, having that basic understanding of okay, how is bookkeeping being done, right? Because you're going to hire someone to do your bookkeeping. You want to make sure that to a certain degree you can hold them accountable, or marketing, or HR, and these different things. But I think that there is kind of a line where it's okay, where can we, kind of leverage some of their skill set on some of those higher level things to be able to give some of this data in a clear way.
Yeah, and one thing that Joe, you mentioned before, it's like kind of like going to the doctor and then telling you like what is going on, right, under the hood. So if I look at this at a glimpse, I see one, asset usage. I'm not doing that well in that, so I need to find a way to better utilize my trucks, machinery, equipment, so that it can create more profitability with my client, and then we can discuss more strategies behind that. But five, leverage. It looks like right now I'm paying off debt or I don't have too much debt. My company is doing very well with debt. Four or five, that means I'm doing good. One or two, poor, and then three is average. So that's why it's important to kind of um, compare yourself, you know, to benchmarks, because you want to know, it helps you diagnose where to focus your time and energy, because there can be so many things in a business, and it helps you break that down.
Yeah, and it doesn't mean that there's necessarily something wrong, right?
No.
You're kind of using this as a baseline because in this example, it could also be where the company just decided to invest into a specific piece of equipment that's going to allow them to grow,
Yeah.
right? Which is why maybe their profitability isn't necessarily where they want it to be because maybe they're still learning how to utilize that on projects or and now as they grow in revenue and profitability, now they're going to be utilizing that asset more, right? So it's just kind of looking at the full picture. Often, if you look at one thing, it doesn't tell the whole story. So that's why it's good to look at different aspects of the company. And here's an example where, we always recommend to kind of look at your numbers, some of your expenses, and then compare it to the previous year for that same time period. Especially in a seasonal business, that's where you're going to see um, a lot of helpful data, right? Because comparing January to August or January to December, that's not going to maybe tell you as much because of some of the seasonality aspect. Um,
This is a percentage to revenue. So if we look at salaries and wages, field labor, that means that 20% of their revenue is going towards that expense in 2023. Then if you look at 2022, it looks like 2022, tongue tied there, 22% of their revenue was spent on labor costs, right? So they were able to decrease that by 1.38%, which is nice, right? And then we compare it to industry median on the left, on the right, sorry, compared to the industry average, 14%. So it looks like they are spending a little bit more in this area than the industry average. So that may be like a conversation piece where we talk about training, or maybe they just hired a new crew, whatever that is. We want to diagnose that area and kind of come up with a solution, or just know what's driving that.
and then when you're scaling, there's going to be times, and it's not fun, right? Because you've put a lot of time into the company, you put a lot of energy, you start to make great profits, right? Maybe for those of you that are solo operators, maybe thinking about hiring your first employee, that's when all of a sudden now you're going to have to incur that expense, right? So that's around point B here, right? Where now your expenses are starting to increase.
Yeah.
But what we recommend is don't forget about that ROI perspective, and sometimes it just takes that investment, right? And then you start to make that revenue again, right? But then you get to point C, right? But that's how you ultimately climb and really try to get to that next level. And I think a lot of companies make that first investment when you start the company, but then I think maybe from what we see, I think people get almost too conservative, right? But I think just try to think more in terms of ROI. And okay, if you put this amount into marketing or this amount to software or this amount to this resource, we should be able to get that extra in return. Or even if you think about hiring that employee, don't even look at it as an expense, right? As long as you're pouring into marketing and your company can support it, and if you know that you're gonna have to pay them, let's say 40,000, you might have to generate 110,000 to cover that roughly, or whatever it is. That's the plan, right? To basically scale. So, um,
Hey, Joseph, just to hop in here, this is a great chart and photo. A lot of guys are saying the same thing in the chat. This is like right where my company's at. I don't know if I'm B or C, you know what I mean? But it's just kind of funny because as you continue to grow, it's like revenue could lag or profitability could lag. It's just really fun conversation as I navigate this, even through my own business. I've told
yeah,
my guys, I said, there's not really a lot of extra quote unquote money in the game for me over the next 12, 18 months as we scale to a million, 2 million. I said, now we'll hit another sweet spot and then we can
yeah,
reevaluate and kind of get the base camp and then decide
Exactly.
if we want to get to that next A to B or B to C, right?
Yeah.
But that's, you hear like stay small and keep it all. That might be like the line up until B. It's just you and a trimmer guy that you know, um, like you said, you paid $15 an hour, which is nominal, right? But then C, you might be running $1 million and you're realizing 950 is going out the door to generate that. And you're like, 50 grand, I made 100 grand as a owner operator. I'm making 50 at a million. But then D at, 1.4 million, you're making $300,000 with company profit, right? So like, I not to jump ahead or steal any thunder here, but this is like a phenomenal visual, and it's as soon as I saw this, I'm like, man, I wonder which one I'm at, B or C. You know what I mean? Because it's
Yeah.
it's a struggle when you're in the middle, brother. It's no man's land. So anyway, back to you. So
Yeah.
Yeah, no, it's a hard place. I mean, especially like I feel like companies around the 1 million, like you have a project manager, but the business owner is still involved, but you kind of hit a nice point where you're not too overwhelmed with like administrative work, but then you get to the 2 and the 3 million, and then maybe you don't have enough resources to take that over. So you're in another like pickle where you need to invest back or wait a little bit until you grow more and then invest back. So yeah.
And yeah, a solo operator a solo operator that's working 100% in the field could actually make the same net profit typically as someone that has 3 or 4 employees, and that is kind of out of the field. So it also depends on how involved you want to still be in the field operating. The longer you stay in the field, the more profitable you'll be as a percentage. Um, but there's also a benefit to those of you that do want to grow and add on a team and build an enterprise value. Um, because if you do want to sell in the future, that's going to make your company worth a little bit more, right? Rather than being a solo operator. But there's also a lot of benefits of being a solo operator. So it's just different ways to, kind of look at it. But yeah, it's a, definitely something to think about. And then I think looking at sales, right, and trying to be as realistic as possible with that, because you don't want to be in a position where you budgeted and you felt like you can cover certain fixed costs and overhead costs, but because of certain changes or things that happen within the company, now you're in a little bit more of a cash flow crunch, right? So trying to be as realistic and base it on your data, right? So if you're going to grow from 200,000 to 400,000, understand that that's a what 100% growth or you know so if you grew from 150,000 to 200,000, but then now you want to go from 200 to 400, that's actually tripling your growth rate or quadrupling your growth rate. So making sure that you have the systems and that your company can support it, right? Do you have any bottlenecks that are going to prevent you from actually accomplishing that? So not just on the marketing and sales, but on the recruiting side, on even on the accounting side, right? And the estimating side. So looking at all aspects of your company and trying to, see, okay, can we support that, um, as well? And is it a price increase, right? That's going to be your quickest way to ultimately increase revenue. That because most of that goes right to your bottom line in essence. So the average spend on marketing is like 1 to 2%. So um, and I do want to touch on Daryl's question because he said, so my 126% growth that I set this year might not work. So that completely depends, Daryl. That could be completely reasonable if you're, let's say, going from 200,000 to whatever that math comes out to, 450,000. um, that could be reasonable. Now, when you look at 126% growth rate for a company that's maybe a little bit larger, going from 2 million to 4 million, it's a different story, right? Because that jump, that could mean just adding, an employee or an employee and a half, right? So it's again, it just comes down to how confident you are with being able to support some of the other parts of the operation. Um, so and then yeah, and then as for this, really the main thing here is, yeah, it's nice to get that revenue um, return on your investment in regard to marketing, but also try to see, okay, if we're going to spend this amount on marketing, how much are we going to get in return in your net profit? So you can see, typically you kind of shoot for around a 50% return on that additional spend that you might spend on marketing. So here you spend an additional 80,000 under the 2025 goals, 50% return on that's around 40,000. So then you can see the net income jump. And again, we could send this over to Brian um, as well. And then managing debt, right? So making sure that the company is not over leveraged. Um, almost similar to how you would look at a house where your liabilities is your mortgage and assets is your home value. If your mortgage made up 95%, then it's a little bit more of a risk for the bank, right? So looking at your company is in a similar way to to that as well. And then coming up with a game plan, right? So based on how your cash levels are and um, being able to pay off debt, um, trying to really track that throughout the year and coming up with a plan. Understanding the total cost of the debt, you know, even just from a psychological perspective, trying to knock out some of the small ones first. If you have some of the smaller loans. Um,
Yeah, and don't get like discouraged, because one of the ways that we help um our clients out is we establish like a new savings account. And some of them like even start out like just transferring $200-300 a month or something like that. But the thing is that once you see that money coming through, and maybe it gets busier for you over the summer, and you can increase that amount, and you have the ability to do that. Like after 6-7 months, we have a good nest egg there to pay down maybe the smaller loan, right? And so it just feels good to be able to pay off some of these loans, and it's not impossible if you go about it with a solid plan as well.
yeah.
Hey,
Hey,
Joseph,
yeah,
can I just ask a quick question? I get this one quite a bit about paying off debt. It seems like broadly speaking, we're all, let's just say, you grew up in a middle class education, family, life. You just hear debt's bad, right? For the most part, nobody really quantifies like good debt, bad debt, or basically debt used for business to potentially help grow the company to
Mhm.
then, like you said, leapfrog ahead. A question I get, or sometimes when I'm doing coaching calls, people hyperventilate, right? They're like, oh my God, I've got mower payments and truck payments, and I just can't wait to pay them off. And I'm thinking to myself, well, like, sure, I guess in theory, we would like to maybe work
yeah,
more to no debt or a cash position, but would you be able to like articulate or any analogies or strategies that you guys might be able to help folks with understanding like that maybe debt's not necessarily bad or paying it off too soon is actually not necessarily bad, but it
yeah,
might not be the next best thing. It might not be your first move versus maybe
yeah,
having like Carla just said a little bit of a nest egg or a savings account or a burn rate. Like don't think that payments alone or debt alone are terrible. It's kind of just how you manage it. So can you talk to that for a few more minutes? I think there's a lot there for
yeah,
some guys that just freak out. Like I'll never pay off my truck, and I'm like, it's not necessarily bad if you do or don't. It just depends on your strategy, right?
yeah, yeah. Absolutely, Brian. No, that's a very common thing that comes up, and I think even just going back to this example, just from a bird's eye view, you can see leverage. This company is not over leveraged. They're doing well in regard to debt. But then I think you also have to think about it too, where almost like Warren Buffett, he's a billionaire investor, right? And his big main job is to allocate resources and money where he can get the best return, right? So if you think about that in your business, is it best that we pay this thing off, or is it best that I actually pour that money into marketing and I increase profitability and I really grow the company, right? So I think that there it's always going to be riskier to utilize debt, but it just comes down to what your risk tolerance is well. But I think a healthy level of debt is typically not a bad thing. So
No, I mean in a landscape company, this industry, we have debt. Like we have a lot of trucks, machinery, and equipment, whereas other businesses like consulting or something like that, it's not going to have as much debt, right? So it's a normal part of this industry and the business. So that's okay that you have some debt, right? But you have to look at the market that you're into. Is it a market with a lot of ebbs and flows, and you're exposed to more risk because your market is unpredictable? And so you want to decrease your risk because you don't know what's going to happen in the non-busy season or in your market. So you may want to pay off your debt quicker in that circumstance, right? But if you live in a market where it's more sustainable, you don't have a lot of those up and downs, um, and and you kind of are okay with the cash flow, and we're okay with your like leverage ratio and all of that, then there's no rush in like paying that down, because then that money could be used towards other efforts. Yeah.
The thing that I've asked quite a few leaders about that topic, and you guys were at the mastermind, and I think Mark said like on average, a company that reinvests profits for future growth is seeing something like was like 43%, basically a cash on cash return back in their own business, versus taking those profits out and of course doing whatever you want with it after that. Let's just say you put into the stock market is making it 12%, putting that money back into your own business could potentially be the
Yes.
best investment you make. And like Joseph said, in addition to that, you're building enterprise value. And that's a whole other conversation, that we could
Yeah.
always do a 202 on. But do you guys, basically, a quick question for you, maybe just to help some guys out. Like, do you have any KPIs or benchmarks for the industry on average about what a debt load could be or should be for a company based on
Yes.
revenue? Like I've heard, like Troy
Oh,
Clogg, my friend, he's like 10% of revenue, for leverage with that. I know some guys are as ambitious as 20%. Do you guys have any suggestions or rules of thumb? And again, I know every business is different, but what's like a healthy number?
we don't have it like measured against revenue. We have it measured against your assets. And the
Okay.
reason why we measure it against the assets is because the assets are your trucks, your trailers, your machinery equipment, right? That's what really you're pulling out those most of those liabilities for. So I think comparatively, it's a really good metric to look at is liabilities to asset, and the median for the industry is 0.8. So what you want to be under one, because you don't want your liabilities, what you owe, to be a larger number than what you own in the business. You don't want your debt to be larger than all your assets and your cash in the bank, all the assets that you have, right? So this means that um, when you look at this ratio, it's 0.8, right? So when you measure the liabilities to the assets. For a lawn care company, 0.8. For more of like a material intensive work is 0.7.
And there's other ways to look at risk, not just debt. So looking at client concentration, so making sure that not any one client makes up more than 10% of revenue typically is a pretty good benchmark for that. Um, making sure that you're implementing progress payments, right? And you're collecting, looking at cash flow, larger projects, if, making sure that you're doing job costing because there's more risk that's involved with those. So here's, just a couple things to kind of consider. And then for the accounting side, so you have both tax and a managerial accounting, which is why we have two separate departments here at Cycle CPA because it's two separate efforts, right? You have tax, trying to decrease tax liability as much as legally possible. But then you have almost like a company would have a full-time CFO. You want to look at things from a profitability perspective, cash flow, managing risk, right? So looking at it through both of those lenses, that's really what we kind of recommend.
We'll let you guys get out of here. If anybody needs to reach out to Carl and Joseph, cyclecpa.com, you can check them out there. Tell them that you saw the Zoom with them, or they're in the group. Obviously, I wanted them to just be a resource. So if you guys ever have any bookkeeping questions or light tax questions, I'm sure they could try to lend an ear and help you guys out a little bit. But I really try to keep this group very safe and protected and not salesy or spammy. And so when I invite people like Adam and Lauren in here or Carla and Joseph, it's for a reason. Like I know where their heart is. So you guys are in good company. Uh, if you do need any help with bookkeeping, check them out. But just please, if I could beg, or my heart's desire would be, start collecting enough data, start putting your financial ducks in a row to really build your team out this year. It's nominal. It's just a line item. A couple $100 a month will go a long way. Before you buy, the Lariat Sweet F-250, or you start taking money out to go buy a boat, okay? just build your team first. It'll be the best money you spend, for sure. I know it was for my wife and I as well. So that's where we'll leave it. Guys, thank you so much. Love all y'all.
Thank you.
Thank you to Cycle for joining tonight. If you guys are new here to the group, I know a lot of people are joining left and right. It's awesome. Welcome out. This meeting a little bit different. We had a special guest, if you will. We'll have another bidding and live session next week, Wednesday, 9 p.m. Eastern. So just if you're new, welcome out. Just want to say hey and appreciate all of you guys. So everybody have a great night. Love y'all. Appreciate y'all.
Thank
And
you.
we'll catch up with you soon. See you guys.
Good night, everybody.